Yeah, hey there, it's Paul here from freedomtraderpro.com. Now in this video I want to explain what are liquidity pools in Forex. Okay, so I've got the US 30 chart up in front of me, but what I'm actually going to do beforehand is just draw out and kind of explain to you on the whiteboard what this actually is. Because as you probably know, the markets are massively manipulated by the banks, and the aim of their trading is to take your money, because they can't take money out of the market unless it exists in the market, if that makes sense. So for every buying transaction, there's a selling transaction. For every selling transaction, there's a buying transaction. So in order for the banks to take your money, or in order for the banks to win, they have to take your money. So let's just take a nice and easy pattern, for instance, like a double top. So people are taught when there's a double top, you can sell the market, or when there's a double bottom, you can buy the market. So what the banks do is they automatically generate these patterns into the market so that they can take your money. So I'm just going to explain that. So we've got here, let's just say the market was doing this. So what would basically happen is this here would be classed as a double top. And what would happen is there would be umpteen retail traders looking to sell at this point here so that they could move the market in, looking to sell there. So they would basically profit from the market moving in a downward direction. So what happens because of that, everybody puts their stop loss somewhere, I don't know, somewhere above here. Might be 10 pips, 30 pips, whatever it is, they put it somewhere up here so that it allows for a little bit of movement in the market. So consequently, you've got all this liquidity sat up here. Okay, so you've got all this money sat up here from retail traders. They've all sold here. The market's coming down. All of a sudden, what happens is the market spikes up like this. It takes out all this retail trader stop losses. It takes out all this money, and then they basically move the market back into the intended kind of direction. So you come along here, spikes up, takes the stop losses, which means the bank can then basically get their hands on that money to move the market in the direction it was going in the first place. So hopefully that makes sense. So what I'm going to do is explain this to you. Let's just get rid of this. I'm going to show you somewhere in the market where this has kind of happened, because it happens time and time again. This is kind of how the banks manipulate the markets, and it's not just that one pattern. It could be trend lines, it could be anything. I'm just using that as an example so that you can kind of see what's going on. So let's just say look at the 4-hour chart, just as an argument, just so we've got something to kind of focus on. Okay, so if you look at this here, so what happens is you've got all these double bottoms here. In fact, if I just what I'm going to do here is I'm going to come back. Let's get rid of this so that I can go to a smaller time frame so you can actually see it a bit better. Okay, so here you've got one touch here, another touch here. That would be in the retail market be classed as a double bottom. Okay, so below here you're going to have some stop losses. Okay, so you're going to have some money all sat below here because of this double bottom here. And then what happens is the banks force price down and they force it back up. So if we come back to the 4-hour chart, as you can see, you've got money sat here, they forced it down, and then if we just play this forward a little bit, they do it, force it down and force it back up. Okay, and that's basically how they get their hands on that money. They basically take the liquidity that's here, it's called a liquidity pool. So they take that money and then they move the market in the opposite direction. And it happens literally everywhere you look. If the more you kind of look out for it and the more you get accustomed to seeing these patterns in the market, you just realize that it's just manipulation after manipulation. Again, look at this here. We've got these, I mean, it's not a double bottom as such, but you've got this liquidity here. They spike down and move the markets up. So they take out these people's stop losses here and move the market up so that they can get their hands on that money. Let's just come over here. We've got a couple of, that would be a double bottom on a smaller time frame. Okay. In fact, I'll just take that off there and I'll show you. If we come back here, it's just easier to do that. Put it on a smaller time frame. As you can see, that's a double bottom on a smaller time frame. Just come back to the 4 hour. So we're back here. Play this out a little bit and just watch it spike down and back up. See, that's basically what the banks are doing. They're getting all these patterns, manipulating the market, stopping people out, taking their money so that they can then effectively win their trades and take money from, you know, everybody doing this and everybody trading these patterns. So hopefully this kind of makes sense. I've tried to explain it as best I can. Any questions, anything I can do to help, pop me a comment below. If you're brand new to this channel also, please consider subscribing, and I look forward to talking with you again real soon. Take care.